Welcome back, everyone. If you're an internet listener looking for the smartest insights into the tech world, you are in the exact right place today.
Yeah, we've got a really fascinating one lined up for you.
We absolutely do. So right now, the most advanced, highly coveted AI chips in the world, I mean, the ones currently powering this entire global artificial intelligence revolution, they're actually generating a lower profit margin for Samsung than the boring conventional memory chips sitting inside like a 5-year-old corporate desktop.
It is so wild to think about.
Right. Today, our mission is to unpack Samsung Electronics' jaw-dropping Q1 2026 earnings report to figure out how this profit inversion is even mathematically possible and, what it tells us about the future of global tech infrastructure. Okay, let's unpack this.
Yeah, because it's a dynamic that completely upends our standard assumptions about technological value. You naturally expect the absolute bleeding edge of silicon to, command the ultimate premium.
Oh, for sure.
But the internal mechanisms of how these memory markets actually operate tell a completely different story.
They really do. But hey, before we get into the billions and trillions of one and the mechanics of these chip markets, I need to jump in with a quick mandatory disclaimer.
Oh, right. Yeah, very important today.
Yes. So all the information and analysis we are chatting about here is just to help everyone better understand the market. It is absolutely not investment advice. Investing involves risks, so please make sure to do your homework before entering the market or consult a professional financial planner.
That context is vital, especially when we are analyzing an entity like Samsung, which, let's be honest, essentially functions as a bellwether for the entire global economy.
Exactly.
We're looking at the underlying physics and economics of the supply chain here, not making stock predictions.
Right. So let's start with the sheer velocity of the capital moving through Samsung right now. Looking at the Q1 results, revenue hit 133.9 trillion Korean won.
Which is just a staggering number.
It's massive. That's up 69% year over year and 43% quarter over quarter. And the operating profit, that hit 57.2 trillion won.
Yeah, to put that into perspective for you, they generated more profit in this single quarter than they did in all of 2025 combined.
Which is insane. And we need to do some jargon busting here to explain how they did it, because Samsung loves their corporate alphabet soup.
They really do.
So you'll hear DS and DX.
Yeah.
DS stands for Device Solutions, which is basically their semiconductor and chip division.
The folks actually making the silicon.
Exactly. And then DX is Device Experience, which is the consumer stuff. Your Galaxy phones, your TVs, the things you actually buy at the store.
Right. And the hero of this quarter, without a doubt, is the DS division, the semiconductors.
Oh, yeah?
When you look at the breakdown, that semiconductor division pulled in 53.7 trillion won of that profit.
Wait, out of the 57.2 total?
Yep. Which means a whopping 94% of Samsung's total corporate profit came just from making chips.
Wow. One of the largest consumer electronics brands on Earth, and 94% of the money is just from the underlying silicon.
It's incredible.
Yeah.
And the reality of why this happened is that the global build-out of AI data centers has created an insatiable hyperscale demand for infrastructure.
Right, because we aren't just talking about chatbots anymore.
Exactly. We're moving past basic large language models into these agentic AI systems. Systems that require persistent memory to execute multi-step actions on their own. And that requires a scale of compute density that is, frankly, unprecedented.
It's like, okay, think of Samsung as a massive, miles-long freight train heading up a really steep mountain.
Okay, I like this.
The semiconductor division isn't just one of the cars on the train anymore. It has basically become this massive locomotive engine single-handedly pulling all the other businesses up the mountain.
That's a great way to look at it.
But, if AI chips are the fuel driving this massive ship, they must be the most profitable product.
Well, actually, no.
Here's where it gets really interesting. During the Q&A portion of the earnings call, Samsung's management openly admitted that traditional conventional DRAM memory, the older stuff, is currently more profitable than the highly advanced HBM, or high bandwidth memory, used in AI.
Yeah, the margins are actually higher on the old tech.
I mean, how is that even possible? HBM is the absolute bottleneck for NVIDIA and AMD's most advanced AI accelerators. How is standard commodity DRAM out-earning it on a margin basis?
It all comes down to the stark differences in pricing mechanisms and contract structures. It's the why behind this whole profit inversion paradox.
Okay, break that down for us.
So high bandwidth memory, HBM, isn't a commodity you just buy off a shelf. It relies on annual, long-term contract where prices are locked in advance.
Because it's so hard to make.
Exactly. You're literally stacking silicon dies vertically and punching microscopic holes through them to connect them. The lead times are massive. Because of that, the hyperscalers, the massive cloud clients, they demand price stability to help them plan out these multi-billion-dollar AI systems.
Okay, so HBM is kind of like renting an apartment on a fixed 12-month lease.
Yes, perfect analogy. The client signs the 12-month lease, the supplier gets guaranteed revenue, but the supplier completely forfeits the ability to raise the rent if the neighborhood suddenly becomes the hottest zip code in the world.
Right, they are locked in at that price. So what about conventional DRAM?
Conventional DRAM uses quarterly pricing. It operates much more like a spot market, reacting instantly to market demand.
Oh, so if HBM is the 12-month apartment lease, conventional DRAM is like booking a hotel room where the rates dynamically surge during a massive convention.
That's exactly it. Because the AI boom has eaten up so much of the global manufacturing and packaging capacity, the overall supply of conventional DRAM is suddenly really scarce.
Right, there's no room at the hotel.
Exactly. Supply vanishes, demand remains static or grows, and the price and the profit margins just skyrocket. The hotel is suddenly operating at a higher profit margin tonight than the luxury apartment building next door.
That makes total sense. But wait, if you're sitting on the board of Samsung and you see that conventional DRAM is currently offering a superior margin, wouldn't the instinct be to demand a pivot? Like, hey, stop making HBM, let's churn out more conventional DRAM and capture that short-term cash grab.
You would think so, right?
Yeah.
Wall Street generally hates leaving money on the table. But if we connect this to the bigger picture, we see a crucial strategic decision.
Which is?
Samsung is outright refusing to chase that short-term cash grab. They are deliberately prioritizing long-term AI ecosystem growth.
Because if they starve the market of HBM,
They bottleneck the entire global build-out of AI infrastructure. You literally cannot train the next generation of foundational models without that memory. If AI development stalls because of a memory bottleneck, the entire supercycle cools down.
so they're effectively subsidizing the momentum of the AI revolution at the expense of their own short-term margins. Because they know if the AI ecosystem thrives, they'll make it all back when those annual HBM contracts renew at higher base rates.
Precisely. It's a calculated long-term play. But, that very same soaring price of conventional DRAM is creating a massive headache internally.
Right, the internal squeeze. Because memory chips are in such high demand and prices are surging, it creates a brutal reality for the people buying those chips. And ironically, that includes Samsung's own mobile and display divisions.
Yeah, it's fascinating to watch a vertically integrated giant wrestle with itself. Its greatest triumph in one division is the biggest obstacle for another.
Let's talk about the MX division, the mobile experience team. They just launched the Galaxy S26 series, right?
And it was a successful launch, too.
Extremely successful. The sources show they had higher average selling prices, mostly driven by the premium Ultra models. Yet, despite that success, the MX division saw their operating profit decline by 30% quarter over quarter.
Yeah, a 30% drop. And that's entirely because rising component costs are eating their margins.
Because their own semiconductor division is charging them the surging market rates for memory.
Exactly. The mobile division's bill of materials has skyrocketed. But they can't just slap a 30% price increase onto the consumer without destroying smartphone demand. So the mobile division just has to absorb the hit.
Wow. And we see this exact same nuance cascading into the SDC, the display division.
Right.
Mobile displays dropped due to standard spring seasonality, sure, but also because of these exact same memory price pressures on smartphone makers globally.
When a phone manufacturer is getting crushed by memory costs, they start cutting costs elsewhere to protect their retail price. Often that means squeezing the display panel suppliers.
But the large display sector for Samsung actually held stable.
They did, yeah.
And the sources point out that's thanks to a boom in OLED gaming monitors. Which makes sense, because high-end gamers are practically immune to macroeconomic trends. They want the highest refresh rate, and they will pay for it.
Yeah, that enthusiast market is incredibly resilient. But to really escape this cycle of component inflation, Samsung has to look to the future. They have to out-innovate the bottleneck entirely.
Right, let's pivot to that future outlook and the roadmap. The earnings call highlighted some major upcoming milestones: HBM4 mass production, PCIe Gen 6 solid-state drives for servers, and expanding AI beyond just mobile into high-performance computing, automotive, and even aerospace.
Which is a huge expansion. But the real battlefield is the foundry business.
Okay, let's do some more jargon busting here for the foundry race. We keep hearing about the 2-nanometer and 1.4-nanometer processes. What does nanometers actually refer to in this context?
Good question. So nanometers broadly refers to the size of the transistors on a chip. A nanometer is 1/1000th of a meter.
So incredibly tiny.
Unimaginably tiny.
Yeah.
And in the chip world, smaller means you can pack more transistors into the same space.
Right.
That makes the chip faster and significantly more power efficient.
But I imagine it's also ridiculously difficult to manufacture.
Oh, it's brutal. At the 4-nanometer level and below, you are battling quantum physics. The physical gates controlling the electrical current are so microscopically thin that electrons can literally pass through them when they're supposed to be closed.
Which creates heat and ruins efficiency.
Exactly. So getting a reliable manufacturing process at these nodes is the holy grail.
Which brings us to a massive foundry win highlighted in the sources. Samsung's 4-nanometer yield has officially surpassed 80%.
Yeah, and hitting an 80% yield, meaning 80% of the chips on manufactured wafer actually function perfectly without defects, is the absolute threshold for commercial dominance.
And it seems the industry agrees because that 80% mark has attracted massive orders from companies like Roque, IBM, and Baidu. They are trusting Samsung with their silicon.
They are, but even with that manufacturing success, the demand curve for AI infrastructure is completely warping the traditional tech cycle.
Oh, you're talking about the 2027 panic?
Yes, the 2027 panic.
Yeah.
This is perhaps the most mind-blowing detail from the whole report. AI infrastructure demand is currently so far beyond the available global supply that panicked customers aren't just ordering for next year. They are locking in orders for 2027.
Wait, 3 full years from now?
Yes. 3 years in advance. They're committing billions of dollars in non-refundable orders for foundry capacity that doesn't even exist yet.
That is just wild. I mean, the AI landscape changes every 6 months. How do you even know what kind of silicon architecture you're going to need in 2027?
You don't really. But from the perspective of a tech giant, the risk of misallocating capital on slightly suboptimal silicon in 2027 is vastly outweighed by the existential risk of having no silicon at all.
Wow. It's literal panic buying.
It really is. They're terrified of being left behind.
But I do want to bring us back down to earth for a second with a neutral macro check. Because despite all this locked-in demand for 2027, Samsung's management was very clear that 2026 will still be a challenging year.
Yeah, they were surprisingly cautious about the immediate future.
Right. They acknowledged that there are highly unpredictable external factors at play, specifically mentioning geopolitical risks and potential shifts in global tariffs.
And we aren't taking any political stance here or criticizing any specific government or entity. But impartially speaking, supply chains are fragile. You can have all the 4-nanometer orders in the world, but if trade routes or tariffs disrupt the cost of raw materials, the whole economic model gets strained.
Exactly. It's a pragmatic reminder that tech doesn't exist in a vacuum. So what does this all mean for you?
We've covered a lot of ground today.
We really have. Just to recap, we looked at Samsung's historic 133.9 trillion won revenue quarter, driven by an insatiable AI demand. We explored that fascinating reality where old conventional memory is actually out-earning new AI chips because of the difference between spot pricing and fixed contracts.
And how that chip's success is creating an internal squeeze, actively hurting their own mobile division's margins despite selling a ton of new Galaxy phones.
Right. And finally, the sheer insanity of clients booking foundry space 3 whole years in advance just to guarantee they have silicon in 2027.
Yeah, which actually leaves me with a final thought I'd love for you, the listener, to mull over.
Oh, let's hear.
We always think of software and AI models as the drivers of the future, right? We idolize the coders and the researchers. But if the world's biggest tech companies are already panic buying raw silicon for 2027, who really holds the ultimate power in the AI revolution? Is it the people writing the code or the people forging the glass and silicon?
Oh, that is a great question. A digital revolution entirely bound by the physical constraints of manufacturing.
Exactly. Something to think about.
Definitely. Well, thank you so much for joining us on this deep dive. Keep questioning, keep learning, and we'll catch you next time.